Hey everybody, welcome back to DeFi Supply. My name is Caleb, and today I want to give you the 10 best stablecoin farms for 2022. I've scoured many different Twitter threads, looked at many YouTube videos, and done a ton of studying with this subject, so you don't have to. With that, let's just jump right into it. So, you've noticed that crypto has really taken a beating. Bitcoin's down almost 50% from its all-time high. But you'll notice actually that DeFi is still really strong. So, the TVL, or total value locked across all blockchains, actually peaked at around 250 billion, and now we're around 200 billion. So we've actually only dropped roughly 20% from the all-time highs with DeFi. So DeFi is still strong. Hundreds of different protocols are still in development, and there's still billions of dollars worth of liquidity incentives out there for farmers and for other people just looking for stable yield to accumulate. So I actually created this Substack article just detailing each strategy that I have found to be very conservative, but then also having really high yield. So if you want to check it out, you can check it out at defisupply.substack.com. So with that, let's just jump right into it. So the number one protocol that I have found is with Anchor-Earn. So you've probably heard of Anchor-Earn before, and still pretty standard. You go to this website, anchorprotocol.com, and what you're going to do is you're going to be depositing US Terra or UST from your Terra Station wallet into this protocol. And what it's going to do is it's going to use a variety of techniques to give you an APY of about 19.5%. And they generally target this rate. It'll fluctuate a little bit, but as long as I've been covering it, it's actually been pretty steady. So once you deposit UST, it's actually going to give you back AUST, and that AUST is going to be appreciating in price. So you're not actually going to be earning interest that you collect. You're just going to be earning value with the AUST tokens that you're holding on to, which provides a whole host of tax benefits as well. And if you want to learn a little bit more of how this yield is generated, check out this newsletter here. I'm just going to be giving a rough overview of each strategy, since this video is going to be probably pretty long once I get to the end of each strategy. And I also have diagrams as well. So basically, as I said, you're going to be depositing UST into this UST pool, and basically there's going to be UST borrowers that basically use your UST and supply collateral, and you're going to be basically gaining the yield from borrowers basically paying to borrow, and then also giving up their collateral, which earns interest, which will also go to those lending UST out. Coming in at number 2 is the MIM plus Yearn strategy on Phantom. So what you want to do with this is you want to acquire MIM on Phantom Network, and you want to go to Yearn Finance /vaults. And what you're going to find is you're going to be on the vaults page, and below it you'll see all these different assets here. And one of them you'll find is MIM, and they're going to be giving you about a 17.5% APY. So this is going to fluctuate. Before it was, I think, up to like 40%. Now it's gone down to 17%, but it's going to most likely equalize around here as DAI and USDC has. So it's very simple. So you just go to Phantom Network, you connect to your wallet, and you're just going to be depositing MIM here. All right, coming in at number 3 is the MIM UST Degenbox strategy. So this strategy has actually come into a lot of heat lately. There's been a ton of drama going on with Wonderland and their association with Terra and UST, and the fact that people are leaving MIM, thus kind of driving down the price of UST. But I still think that this is a very, very good strategy because the fundamentals are still there. It's just unfortunate that Wonderland drama is kind of tainting this strategy a bit. But if you have assets on Ethereum, what you want to do is you want to go to abracadabra.money/stand, and what you'll find is a page saying to connect your wallet. So what I'm going to do is I've actually just connected my wallet, and I'm going to be switching to the Ethereum network. And I'm just going to be waiting a bit. Okay, once it's loaded, you'll find all of these different vaults that you can borrow from. And what you want to do is scroll down to UST. Once you've clicked UST, you're going to be depositing UST as collateral, borrowing MIM. And what this is doing is it's taking that MIM and buying more UST, transferring that UST over to Terra, and basically leveraging your UST position and then depositing all of that into Anchor, which is going to be earning that roughly 20% yield. So it's similar to strategy 1, but going to be a little bit more risky because you are taking leverage and you are relying on UST maintaining its peg. Basically just deposit any amount of UST, and then with that, you don't need to select, you don't need to specify here. You can just kind of click one of these buttons here. If you want to be very conservative, I would put it at about 50%. And then what you want to do is you want to collect this change leverage checkbox. You can read the docs as well if you want to learn more about this strategy, or read my Substack. And what you want to do is you want to basically drag this slider specifying how many times you want to loop this strategy, or how many times you want to leverage your UST position. So right now I'm leveraging at about 6x, and I'm going to be expecting an APY of 106%. The nice thing is they tell you what your liquidation price would be. So if UST drops below 94 cents, you'll be liquidated, your entire position. So definitely keep in mind kind of what your risk tolerance is. I would not go up to, like this 99% range. UST has had instances where it's dipped below 99 cents for a short period of time. So definitely kind of do your due diligence and kind of assess your risk tolerance as well on this. So that's why I've kind of labeled it as low to medium risk, because it depends on how much leverage you take out. But regardless, even if you take a relatively conservative approach, you're going to be getting a yield anywhere between 60 to 80% on a conservative approach, and you can get 100% APR plus if you want to be a little bit more risky. All right, and then for the number 4 strategy, it's going to be Mirror Finance delta neutral strategy. So basically what this is, you're going to be longing and shorting the same asset and being paid to do it by the protocol. And why do they pay you, you might ask? Well, they pay you because they want to incentivize you to use their platform. And we're just basically taking advantage of that fact and trading kind of both sides of the trade. That way, if the asset goes up in price, you win and lose. And if it goes down, you also win and lose. So you actually just kind of break even. So basically, the way you want to do this is, it's going to be a little bit complicated. So I encourage you to kind of check out these steps here. But you're going to be going to Mirror Finance, and you're ultimately going to be selecting an asset to trade. I recommend a low volatility asset. So I wouldn't do Bitcoin or Amazon or like Tesla, for example. I would try and do a more kind of conservative approach. So whether it's like Coca-Cola or like oil funds, but the ones that I mostly recommend would be Silver's Trust and Gold's Trust, as well as SPY. So these are going to be fluctuating the least amount. So if you select Silver Trust, basically what you're going to be doing is you're going to be purchasing M Silver with UST. And then with that M Silver, you're going to be shorting an equivalent amount of that M Silver. Okay. And then you're going to be staking your UST M Silver position, which is your long position, earn interest on that, and then also earn interest for you shorting the same position. Okay. So for shorting, you're going to be going to borrow. And with that, you would select still the same asset, so M Silver. You're going to be selecting collateral asset, and you're going to want to select AUST because AUST is going to be appreciating in value. So you don't want to provide just UST. You might as well provide AUST since that's going to be an appreciating asset. Okay. So yeah, I'll just select AUST. And you're going to want to select a collateral ratio. Definitely stay kind of on the safer side, since I'm really advocating for more conservative strategies here. And then you want to select your borrow amount, which is basically going to be adjusted off of this ratio. And then you're going to be staking kind of each of these assets or each of these positions on this page here. And you'll see that just by longing silver, let me just search for silver, you'll be basically getting paid to long this asset by 18%, and then shorting the asset, you get paid roughly 1%. And you're going to be earning more than 18% because, or you're going to be earning more than like that 18% because your collateral is increasing by 20%, at least on the shorting side. So this, I would say, is a medium risk play because you're going to have to adjust your position. So if M Silver is actually very volatile, you're going to have to adjust either your long position or your short position. So this is a little bit more for the active investor, not more of the passive investor. And then here's just kind of a little diagram on how that works. So coming in at number 5 would be Platypus Finance. So this kind of really burst into the scene in the past couple months. Platypus essentially is going to be the place where you trade stablecoins for an extremely low slippage rate. So in order to achieve this, Platypus needs to amass a huge amount of stablecoins. And the way they do this is through incentive rewards. And in this form, you get more incentives by purchasing their native tokens. And so this strategy is a little bit more risky because you're going to be purchasing their native token, which is Platypus or PDP, which could depreciate in value. But what I'm kind of seeing here is you could just purchase a small amount of PDP and get a really high yield on your stablecoins, to the point where even if PDP goes down to 0, you're going to be in the green because you've already made that back just based off of your stablecoins being staked. So that's why I like this strategy. So the way you want to do it is you basically want to go to Platypus Finance, and you're going to be switching to Avalanche Network. And you can take any one of these stablecoin pools, and you can see here that I've tested this out just with like $200, and my boosted APR right now is 16%, and the base APR is about 5%. So with this, I'm making about 20%, and I've purchased just a little bit of their PDP token. I think I purchased around 10% at the time. So even if that goes down, even if that like loses its value, as long as I come out more than 10%, I'm going to be earning that interest back. Yeah. So basically what you want to do is you want to go to a PDP in order to kind of stake your PDP. So here I've just staked a little bit of PDP, around 10, and over time you're going to be accumulating PDP rewards. So you'll see here I'm at 16% APR, but once I claim this PDP that's given to me, I'm going to be getting a little bit higher rewards, just as a reward for holding their PDP token. And this PDP comes just from you holding the PDP, and you can see here it's being given to me at about a rate of 0.14 per hour. So I haven't actually collected this in a while, so we'll see probably a really big increase here in my yield. So transaction's been submitted. So if I go back to the pool, it still says 16%. Maybe if I refresh. So if I come back to the pool, now that 16% has increased to a 23% APR. So now in total, I'm getting 28% on my USDC. So this USDC doesn't have any impermanence loss, nothing. So with that, it's a pretty good strategy. Okay, moving on. So the next one would be Revenant. So Revenant created a project called Creditum, which is just kind of another collateral pool where you provide collateral and you can mint a stablecoin called CUSD on the Phantom network. And since the project is so new, they're trying to incentivize people to be in a pool with their stablecoin. So with this strategy, what you want to do is you want to go to Curve. So you want to go to Curve, switch to Phantom. And then you want to either deposit USDC or DAI, and this pool will automatically adjust. So now you'll own roughly 33% of your position is going to be in each coin. And then after you've deposited, Curve is going to be giving you LP tokens, which you can then take to Creditum. And what you can do here is you can then deposit here for roughly 21%. So this has gone down a little bit since I've made this. Yeah, so it was about 30% since I made it. It's come down to 21%. It's still, relatively decent, but that's why it's number 6, not number 1 from Anchor. Okay. And then for number 7, I would say recursive money market strategy on Solana is going to be a very good bet, because with this, you can actually loop your deposits and your borrows to then leverage your position even more and collect incentive rewards that Solana is giving. So the way you want to do this is you want to go to Solend. You want to go to their dashboard. You want to connect your Phantom wallet. And what you want to do is you want to try to put in UST, get a supply, APY of about 11.7% right now. And the reason why I say try is because it's capped at about 15 million UST. If you kind of wait around, you can probably try and squeeze some in. But if you're looking to put in large amounts, it's going to be pretty difficult. But once you do get UST in, you're going to be earning about 11 to 12% on this UST. And what you can actually do is you can borrow, let's say, USDC for 1%. And if you convert that USDC back into UST, you can redeposit it for another 11%. And you can do this with a really high loan to value ratio because they're both stable coins and they're not going to be fluctuating in value that much. And if you can't get money into UST, you can also do this with others. USDC, USDT probably don't really work as well anymore now that there is such a high amount locked into the protocol. But if you have Solana, what you can do is you can deposit your SOL into this pool and earn about 4% on your liquid staking SOL. So you're going to be earning your staking rewards of 6% on top of a 4% yield for lending out that liquid staking token. And on top of that, you can also borrow off of this to then leverage your ST SOL position. So that's actually another really good strategy, but it's not a stable coin, so it's going to be a little bit more riskier. The best strategy in this case would be using UST, not USDC or USDT. So on to number 8 would be with Convex and Curve on Ethereum. So these two platforms are killing it right now. They both have billions of dollars worth of TVL locked, and there's tons of different strategies that you can do with this, but just to keep it simple, you can take your Frax or your MIM on Ethereum network, and these are both stablecoins, by the way, but you can take either one of these, deposit it into a Curve pool. So, for example, if we go to Curve, we switch to Ethereum, you can deposit your MIM or your DAI or USDC. It'll rebalance anyways. And you can receive liquidity pool tokens back and then take those liquidity pool tokens and deposit them on Convex. And the way you do that is you go onto convexfinance.com and you basically want to scroll down to where it says MIM. Okay, so you want to go to the MIM pool, and here you'll see that it's about a 30% APR right now. And all you have to do is just deposit your LP tokens that you received from putting in assets on Curve. So pretty cool, right? So that's number 8. Well, number 9, it's Taro on Phantom. So the reason why I like Taro is it's a lending platform that allows you to leverage your liquidity pool positions, but those are kind of more for riskier plays. So if you're more conservative, what you can actually do is you can just lend your assets so that others can make those risky plays. So what you want to do is you want to go to taro.to and you want to connect your wallet. And then what you'll find here is you'll see on markets is many different kind of pools that you can lend assets on. And you'll see that, for example, on a stablecoin pool like USDC FTM, if you supply USDC, you can get 7.88% APR. And if you supply FTM, you can get 12% APR. So this one's not that good. So I would keep searching here for a better one. So you can see that you can get about 8% here. But I think the best one in this case would be kind of with lower total value locked in the vaults. For example, USDC 0xD. So this one's going to be about 10%. MIM's going to be about 15%. So, you'll find stuff between, 7 to 20% because, for example, with Mematic, you can get about 17.4% APR. So it just depends on which pool you want to go with, which asset you trust the best. So depending on which vault you end up going with, it's going to kind of dictate your risk level. So you can be anywhere from medium to high, depending on what you choose. And then lastly, but not least, there's Beefy Finance. So Beefy is an auto compounder that takes your liquidity pool rewards and just purchases more of the liquidity pool token. So this saves a lot of time and also kind of boosts your total APY derived from your APR. And this one is, again, very simple. You just go to Beefy Finance or beefy.finance. You can go into any network, but I'm really liking Phantom right now. So you can go into any network, but I really like Phantom right now because they have a lot of really good APYs. There's tons of projects here. So you can go here and you can sort by TVL. I like to sort by TVL because these are some of the larger, more conservative projects. So you can go anywhere between like 8.44% to like 15% if you go with USDC MAI. So this one is going to be, again, relatively conservative. These APYs have dropped off quite a bit because of the decreased amount of swaps going on right now. But this is just kind of another alternative form of placing your stablecoins. So I also just wanted to mention as well that it's very important to not actually put all of your stablecoins into one project. I know that it's very tempting to kind of look at really high APYs and just ape into it, but you have to kind of resist that urge. Even with Anchor, I would recommend not even putting everything into Anchor because there's always some level of risk, some level of protocol risk that's there. And you can also check me out at DeFi Supply for more updates and tips on how to invest in DeFi. So with that, I'll see you next time.